So I think the big lesson there is looking to understand whether something really is an incentive or not, whether it's for a property manager or someone else. Are they doing something to really earn that ownership stake, or do you have their true psychology in their mind and where the potential downside could be in a scenario like that? That was an important lesson for me.
Josh Appleman, founder and CEO of Appleman Properties. Today we are joined with Taylor Loht. Taylor manages $250 million in real estate, hosts the Passive Wealth Strategy Show, and teaches passive income strategies. Taylor, we're excited to have you on the show today. If you could let the listeners know a little bit more about yourself.
Sure. Thanks so much for having me. So, as you mentioned, I invest in multifamily and self-storage as well. I talk about and teach people about real estate investing and escaping the Wall Street casino, as I put it on my show, the Passive Wealth Strategy Show. That really came about for me about 2016 or so. I had been investing in Wall Street, type of investments for years and doing well, but getting frustrated about what I was getting back out of those investments, and also with the kind of progress that I could make in the sense that there's not really any ability to force value and add to our investments in Wall Street other than through active earnings. And discovered real estate investing through a combination of podcasts and reading Rich Dad Poor Dad, which I have a copy on my shelf behind me here, as so many other real estate investors have done, reading Rich Dad Poor Dad. And got into multifamily, and here we are.
Yeah, that's I'd say Rich Dad Poor Dad is it's the most instrumental, just because of the mind shift, and then kind of taking a second look at the way you spend money and how everything kind of works. But that's huge. And now you help other potential investors find great deals and invest alongside of you. And if everything goes right, they make great returns. Is that correct?
Yeah, that's right.
What areas are you all looking as far as areas investing in? What markets?
So today we're investing quite a lot in a few parts of Texas. Of course, Dallas is a very classic area for multifamily investing. Investing in Houston, Florida's been good to us. The Atlanta area in Georgia's been going well. And also, we've had success in mid-Michigan. Interestingly enough, folks are kind of sleeping on Michigan and some of those less discovered areas. So pretty well diversified around the country.
That's very cool. So you have an area that's essentially a path of progress, up and coming, and in there early and early stages of development. Is that right?
Yeah, I mean it's a mix between smaller, secondary areas, secondary MSAs, if you will, and more primary like DFW. And that really boils down to looking at economic drivers, multifamily and self-storage as well. We're driven by the local economic environment, supply and demand. Multifamily in particular, very heavily driven by migration, population, and job trends. So investing in areas with job drivers, economic growth, and people moving there who are, generally higher earning if possible. So starting with that, the economic fundamentals, if you will, Econ 101, and then moving into submarket analysis, and also then, of course, the properties themselves. But we can't fight the tide, if you will. We're always subject to local economic conditions.
Yeah, finding the positive net migration trends, that's huge. And that's where really the wealth is found too, is getting in there at the right time, and not necessarily when the herd has showed up, because everything's diluted down at that time. But what are some tools that you use? So you find potentially a good deal from out there, and then you go and underwrite it yourself and make sure that the diligence is done. So what are some tools that you use to do your diligence on your part?
Sure. And we have, teams that do a lot of the underwriting as well. Fortunately, I've been able to get out of that because I don't love spending a lot of my time on looking at these Excel spreadsheets running the underwriting, but I, paid my dues in that regard. But As far as tools for finding economic data, there's a lot out there that local, state, and federal governments put out as far as job growth, migration trends, those kinds of things. I find that local chambers of commerce can be really interesting places, interesting sources for information about what major employers are looking to move to the areas. Although it's important to note that chambers of commerce, they're biased parties, right? They're trying to make their areas look, as
Yeah.
attractive as possible. So you have to do take that with a grain of salt, but look for the data there. Then when it comes to underwriting properties, most syndicators, most people in this business have, their own proprietary Excel models that they put together. But, looking at T12s and T3s and whether their expenses are in line with market averages, whether they're spending too much on the expense side of things. But, personally, I always prefer to look for upside in incomes rather than upside in terms of cutting expenses, because you can only cut expenses so much in, say, multifamily. I think there was a big trend in the late 20 teens, I would say, with folks in this space kind of overly focusing on ways to cut expenses as a way to boost NOI. And you can find ways to cut expenses, but they're kind of a one time thing typically. You get in there and you might find that the current owner is spending too much on landscaping and you can get a better rate on landscaping. Or if you have better scale, heck, maybe you can do a little better on insurance, but insurance rates are climbing pretty
Yeah.
much everywhere. But that's like a one-time boost. I find that a bigger upside in NOI and value comes through just looking for ways to improve properties and ultimately raise rents. Right? Is a property underperforming? Really need to
Yeah.
look for that.
Yeah. I totally agree. And definitely the information is out there, and finding the 20-year outlooks for local municipalities. Those 20-year outlooks could turn into a lot of cases on 40-year outlooks because it just never happens. But you can certainly find out what cities are ambitiously wanting their the future to look like, and then just develop around those areas. Um, so passive investors, you have your LPs, limited partners on your deals. What would be some good questions for passive investors to ask syndicators?
Yeah. So I think it's always important to remember to ask the right questions, but also treat the answers with like a skeptical eye, right? Because if you're asking the right question but not getting the right answer or not getting the full truth, then always remember the incentives of the other person that you're asking a question to. But things like asking about their track record. Have you done these types of deals before? Very important, but also critical that you go and validate that, because again, we've had such a groundswell of folks getting into the space who are doing multifamily deals and say they'll get like a guru on their team and present their guru's track record kind of as their own. And there are really two ways that that kind of guru relationship can go. Sometimes that guru or more experienced party genuinely is involved in the deal. They're actually actively participating in the asset management. Maybe they're doing some capital raising or signing on a loan, something like that, that makes their participation substantive in the deal. So they have a vested interest in its performance. On the other hand, sometimes those gurus are really just collecting a $30,000 check for a coaching program, providing a headshot and a bio for the deal deck. But when push comes to shove, they're not involved with the day to day, with the planning, underwriting, the really things that will determine the success of the deal. So that's where developing an eye as a passive investor for seeing who is really serious in the business, who's legitimate. Yeah, it comes over time, but bearing in mind when you ask that question, you need to dig a little bit deeper and really understand who has the experience here? Are they really engaged in the deal and in the process, or are they just kind of a name in the face and a face that helped the other folks get the deal and kind of helping, provide a facade of
Yeah.
legitimacy, if
No,
you
I
will.
could not agree more, especially on a general partnership, structuring the deal, putting together, responsible for the performance of the deal. A lot of times you have just your social, well, not a lot of times, but there are social media influencers out there, and that's the entire GP. That's the makeup of it. But you don't have a true operator or even a true business owner on the GP. And multifamily is a business. You're buying a business. You're needing to be able to pivot and swing and reinvent the property to make it perform. And yeah, those are the key ingredients to any business to make it successful, and get out there and cheerlead the deal and get it to close. But the real work comes after it closes and getting it to perform. And then, like you said, spotting out these things on the onset, asking those questions and getting the responses. What are some common red flags and syndication deals that you've seen?
Yeah. So I've got a whole 7-part video course for you out there on this for folks that are interested, but we can go through a few of them. Excuse me. So obviously, like I said, the track record is very important. That's number one. Do they have experience? Number two, digging a little bit deeper into their experience and track record, but their experience in the market. If both the sponsor and the property manager, assuming maybe you're hiring a third party property manager, are new to the market where they're investing, to me, that is a bit of a red flag because they really might not know what they're getting into. If they have experience investing in, say, DFW, for example, and they're making their first foray into Atlanta. Let's say nobody on the team either lives in Atlanta or has invested in Atlanta or has boots on the ground experience in Atlanta before on the sponsorship team. And while we have this relationship with a property manager in DFW, we think we'll expand together into Atlanta. We're both going to invest in this process and do this first deal in Atlanta. To me, that's a red flag because you've got two parties in that case who don't have that firsthand experience in the market and are therefore less able to evaluate the deal that they're considering than, say, their competition, also in the market of Atlanta in this case, who have probably already looked at that deal and maybe have determined it's not the right fit. Well, there could be a reason for
Yeah,
that. So if somebody's getting into a brand new market and it's a case of sort of if you'll pardon the expression, sort of the blind leading the blind, then yeah, that's an issue. Go ahead and let them learn that market with their own money, with somebody
yeah.
else's money. But for the passive investor's sake, really avoiding those traps.
Yeah, and there's definitely been a whole slew of properties that have been pumped up and purchased just because of the way multifamily is pumped up. A lot of properties are being sold on a cap rate that was based on a future value, if it was ever able to be valued at that. And we're definitely seeing some shifts happen right now. Um, so why do you move? So you've got different asset classes in multifamily, like anything else. You've got your C class, your B class, your A class, your core. But why did you move from C class to B class?
Yeah, that's a very important one. So I started investing in C class properties back in, the 20 teens when, prices were a lot lower than they are today, kind of no matter what you were investing in. And C class properties were kind of cheap at that time. And the spread between C, B, and A was pretty wide. So we were getting C class properties at a relatively low basis. And it worked at that time, but the issue is in a C class property, they tend to be much older physically. The properties tend to be older. They tend to have much more deferred maintenance. And oftentimes those deferred maintenance items are pretty expensive. And those items can sometimes be hidden from plain view or more difficult to find during a due diligence process. So, that combined with all of the price appreciation that we've had in every asset class really has, to me, made C class properties significantly less attractive. And really, even if that price appreciation and compression between C, B, and A hadn't happened, I would still have moved away from C class older properties, really because of all of that deferred maintenance that pops up. Because when it does, man, it stinks to have a big bill pop up, even if you have the cash in the bank to, say, repair a very major plumbing leak, which we did have happen on an old property about 5-ish years ago. That can be a very serious disruption to your plan. It can hamper your overall returns because maybe you had reserve cash sitting in the bank that you were, it's kind of rainy day money, or maybe you were planning on using it for other expenditures that could really genuinely raise your NOI. It's just, not a great feeling to have those things happen. So moving from C to B puts us in a newer properties, generally newer builds, not built in the 60s and 70s, but more 80s, 90s, 2000s is great. Those are a little bit harder
Yeah.
to find at an attractive valuation. We've even seen some lenders don't want to lend on 1980s properties or older. So that's a big consideration. But thinking about the age of the property and the overall deferred maintenance is really critical in this
Yeah, I was on
process.
a call yesterday and we were talking about just that. Well, this is about cap rates in different areas, determining the cap rates in different areas. And my argument was that it doesn't matter what the area is; it's the asset type and class would determine the cap rate. Because older properties, you need a higher cap rate to offset the what the true return would be, because you do have higher maintenance costs and you do have more collection costs. So if it's call it a 10 cap, your true return might be a 6 or even less, just because you're spending more on keeping the property um, operational, to where you've got plumbing leaks that happen. Just historically, it's just that time era, and it just takes more to operate and collect the rents and on and on and on. Um, but yeah, 1980s or newer. I mean, it's phenomenal if you can find deals. You don't deal with the plumbing, the type of plumbing, the electrical. So totally agree.
Yeah, and those older properties, even, folks will go in and, granite countertops, stainless steel appliances, all the classic, upgrade packages that kind of we're all doing in this space to one extent or another. But if a property was built in the 60s, it was still built in the 60s. It is going to look like a 60s property, even if you update the exteriors and the interiors, just the general arrangement of the buildings or just the architecture. It's always going to look older, and I think that has just an impact on the tenant experience as well. It's kind of some of those soft things that we need to think about that influence our tenants, willingness to pay a
Yeah,
little bit
I think
more.
you can definitely achieve a higher sale per unit price, and also take in your income, of course, into account. But it comes a certain point in time where the building starts to deteriorate as well. All the components. So when you've got these properties out there that they're trying to achieve X amount on the sale per unit, it's like that. You're not taking into account it's still 1950s build, 1960s build, and you're just not ever going to get you can go shopping out there for 100 grand per unit. Just go shopping on LoopNet, but yeah, taking into account different asset classes on the age of the build. Um, yeah, you make your money on the buy. You make your money on buying right, buying conservative, and yeah, it's ultimately it's a business. Um, a new investor wanting to get into the space, they don't know whether or not they should go and buy their own properties and go through all the motions, or invest passively. What would you say would be some do's and don'ts, and some positives and negatives on each aspect?
Sure. So there's a lot to think about really in this process. I could give you a few things, decision making points to consider. So, want to start with the end in mind. What do you really want to get back out of your investments? Are you really looking to build a real estate investment business, or are you looking to place your capital and look to earn a return? That's important to quantify. Now, if you want to build a real estate business, chances are you have some capital you want to place as well. But if you're not looking to build that business and you just want to place your capital, that's a decision point that I think could, give you a clue as to which direction makes more sense for you. in that vein of what you're planning to bring to the table, if you're bringing capital to the table, either way, you should be bringing capital. Another important factor to consider is your time, right? Building a real estate business, doing, acquisitions, buying properties, raising capital takes a lot of time to do this stuff, and it's a lot of work, and there's frankly a lot of rejection. There's putting in a lot of time into putting offers on deals or just evaluating deals that never happen. I mean, it takes a lot of just looking at deals to get one done. And then when you're raising, say, investor capital, if you're bringing investors in, you're going to experience a ton of rejection. And if you're not prepared for that, then you're probably not going to put in what it takes to close and perform on a deal. There's the rejection, there's the time investment. And I think a lot of folks out there who are in the position where they have capital they want to invest, tending to be higher earners, doctors, lawyers, management consultants who are already short on their available time, higher income folks who might be, Henry is the acronym, high earning, not rich yet. Your value of your time may be highest at your chosen profession where you're earning, hundreds of dollars an hour as compared to, until you do a real estate deal, you're not earning anything per hour. You're just investing that time. So thinking about whether you want to build a real estate business or just invest your capital, and also how much time and energy do you have to devote to this endeavor. You might find that you just don't have the time available, or you're not willing to put in the work to actively go do
Yeah,
deals.
I totally agree. Because if you're taking on real estate as being an operator, you could just be moving furniture around, meaning that you're now shifting your time from your expertise over to a whole nother field that now you have to start over and learn the entire process. When you excel on what you focus on, and have this become another income stream for you, just on a different capacity. Just learning, like you said, the end in mind. That's huge. Um, what would be one of the biggest learning lessons that you've had so far in your career?
Well, there have been so many learning
Yeah,
lessons, honestly. It's hard to pick out, probably the most important one, but I'll give you one that was very important for me early on. I invested in a deal. This was in Atlanta very early on in my investing career. I was actually a passive investor in this deal because I do both. Uh, Bought a two apartment complex portfolio in the Atlanta area. And to put a long story short, the property manager wound up stealing some funds from us, and that led to about a year and a half long legal battle between the ownership company, the ownership entity, and the property manager, trying to recoup some of those funds. And part of that was because the property manager, the owner of the property management company, had been given uh, GP shares as an incentive to perform in the deal, which sounds
yeah,
reasonable. And I've seen an awful lot of people do that, thinking that that's an incentive to perform. And, I've actually seen that backfire on a lot of folks, not just that particular deal that I was in, but it's backfired on a lot of operators. And if I can be an armchair psychologist from my own experience there, it led that person to thinking he couldn't be fired, to kind of thinking he could do whatever he wanted to do. And he was ultimately, fired and removed, but that's what led to that protracted legal battle. So I think the big lesson there is looking to understand whether something really is an incentive or not, whether it's for a property manager or someone else. Are they doing something to really earn that ownership stake, or do you have their true psychology in their mind, and where the potential downside could be in a scenario like that? That was an important lesson for me.
that's huge. That's a great gold nugget there, because everyone looks for an alignment of interest, and when you're putting everything into the property management to perform. Essentially, I mean, you're looking at your KPIs, your metrics to make sure everything's in line. But your property managers, your boots on the ground, and they're hiring the representatives on the complex to make all the residents happy. But when you've got alignment of interest, when they're on the general partnership, you feel like, all right, they want it to perform even more. Now they've got ownership. I would have. People do what people do, and ultimately you can't change that. We've had a similar run-in with a property management company, and you can never catch it too early. But when you catch it, you're like, man, I should have caught this sooner. And it's like, when people are trying to sneak things and do things, it's unfortunate. But you just got to micromanage everything and just be on top of it. But ultimately, it's got to make sure everything's performing. So, but if somebody new wants to get into the industry, what path would you suggest that they go down?
So, I mean, again, it goes back to deciding what your own priorities and values are. But assuming we're talking to the person that thinks they want to get more involved on the active side of the syndication and larger multifamily industry, take time, invest some money in going to some of these larger syndication and multifamily events that are out there. There's so many of them. The real estate guys, Jake and Gino, best ever conference I go to every year. That one's my favorite one to go to. But invest time and money into going to those places where people are there doing the thing that you want to do. And when you're there, take some time and sit in the sessions. That's great, but I think you should spend most of your time in the lobby talking to other people and building those relationships, learning from them. If you're kind of looking for your angle on the industry still, learn about what people's needs are. And you can learn that best by just talking to them and, asking questions. But spend that time in the lobby at those events, learning more about the business, meeting people, making connections, and looking for your specific potential value add. Maybe you can, work in help someone with their marketing, and capital raising or something. Now you have to be very careful with that, of course. You could help underwrite, for folks. That is a highly valuable skill and an activity that honestly most folks in the industry don't enjoy doing, sitting in an Excel spreadsheet just underwriting deals. It takes a lot of time to do that. But if you're looking for your angle into the industry and that's something that you don't mind doing, join a team as an underwriter. You could also go look for deals. That one's a bit tougher, these days, and it has been for a few years, building relationships with brokers. But yeah, find your angle by going and networking with people who are already doing the thing that you want to do.
Yeah, I think that's huge. Get in the room, get around the energy, around the people, and just get in there and start learning. Very cool. If somebody wants to get a hold of you and learn more about yourself and how they can be a part of what you're doing, how can they get a hold of you?
Sure, there's a few ways. So mention my 7-part video course. Go to passiverealestatecourse.com. You can check that out, pick that up. Shoot me an email, taylor@ntcapitalgroup.com, or go to investwithtaylor.com.
Awesome. Well, I look forward to following you and just keeping up with your journey, and definitely appreciate you coming on the show, and appreciate your time.
Thanks for having me.
Yes, sir. Thank you. Bye.